Here we've got an interesting project. It's a replacement project. Daughton Toy Corporation uses an injection molding machine that was purchased 2 years ago. The machine is currently being depreciated on a straight line basis, has 6 years remaining life. Current book value of $2,100 and could be sold, so its salvage value or market value today is $2,500. The annual depreciation expense, because it's straight line, is $350 per year. If it's not replaced, it can be sold for $500 at the end of its useful life. Okay, so you have a certain degree of cash flows that would be affiliated with this. They're offered a replacement machine that has a cost of $8,000, an estimated useful life of 6 years, so they'd be ending at the same time, so it's a straight-up comparison. Salvage value, they believe, would be $800 at the end of those 6 years. The machine falls into the 5-year class, so the applicable depreciation rates are 20%, 32%, and so on here for the 5-year class. Remember, 5 years goes over a 6-year period because of the 6-month convention as to when they come in and come out of vogue. Replacement machine would permit an output expansion, so we have a sales impact. We also have greater efficiency, which has a decline in cost. New machine would require that inventories be increased by $2,000, but accounts payable would simultaneously increase by $500. They've got a 40% tax rate. Weighted average cost of capital is 15%. Should they replace the old machine? Well, just as we've seen in prior examples, is you want to try to break this down into a series of problems. What happens initially, the cash flows at time zero. What happens during each year of operation, the operational cash flows. And finally, what terminal conditions come in that last period. So we'll break these things down in the sense that we've done these things previously here. And let's take a little bit of a look at it right here. You've got a couple complications because it's a change. If we were to sell the old equipment and purchase new equipment, yes, we would have the outlay of new equipment of $8,000, but we would also receive the revenue that's affiliated with the sale of the old equipment. So we would have to the good, we'd receive this $2,500 salvage value. Now, the fact that, the fact that the book value, we've depreciated to $2,100, but we were able to receive $2,500, means that we're going to have a capital gains tax. So if this will be equal to a negative of the 40% tax rate multiplied by, and in parentheses, the difference between what we get, the salvage value, and what we said it's worth on the books. So salvage value minus book value, that $400 difference multiplied by 40% is we owe in terms of taxes. Now, this change in net working capital, this is a reference here to what we have going on from both the current asset increase and the current liabilities increase. And it's going to be a subtraction of these amounts. So it's a negative of what's gone on here. So a negative of the $2,000 increase minus the $500 increase that's an offset by our accounts payable. In other words, we're funding part of our increase in inventories by having our suppliers foot the bill by giving us this additional credit in the form of accounts payable. But it shows up as a $1,500 cost up front here. Now, when we shut down the project, we'll turn around and go ahead and make that available. But this is what we're referring to when we're interested right here in the operational or the initial cash flows. So if we come down here to the cash flow line here and simply add those items up that we have in there, we're looking for a net outlay of $7,160. Now, in terms of what's going on here for operations, well, doing this, we believe, is going to have an impact here in terms of our sales. And in particular, we believe it's going to increase our sales by 1,000 each and every period. So what we're going to be able to do is to take that amount, and we're going to have that going each year. So I'll put a dollar sign in play to represent that, and I can simply then copy that and paste it through all 6 years operationally, and I've got 1,000 each time. The next is with respect to this change in cost. We're subtracting whatever our change in cost is, but what we have going on is it's $1,500 to the good. So we want to subtract that reduction that we have in costs and make it 1,500 to the good, but it's going to be the same value each and every period, so we'll put a dollar sign in to try to lock that in and say, fine, we get a net gain of 1,500 for each of these periods. So at this point in time, if we were to look at our EBITDA, we'd add these two together and we'd have a 2,500 value each period. Next, what we're able to do here is to subtract off our depreciation. And you can see what's gone on in here. We have a little bit of a concern because it's the change in depreciation. So the old depreciation was $350 per period. So we already were expecting that. What we want to see here is how has that been modified? How has our depreciation gone up? And we'd like to be able to subtract that part out. So this will be equal to a negative, excuse me. Let's undo that. Okay. So it's going to be equal to a negative, because remember we're subtracting our depreciation before calculating our taxes. And it'll be a negative of change. So we need, first of all, what is the new depreciation? Well, that's the depreciation rate right there multiplied by the depreciable base. And that was given as 8,000. But that depreciable base will be the same for each of these. So let's put a dollar sign in there to fix that part. We have that, but it's the change in depreciation. So here's the new depreciation. We're going to subtract what we would have been subtracting, the old depreciation of $350. Again, since it was straight line, it was the same amount each and every period. So we can put that entire change in there, and voila, here's what we get. Let's put that in dollar format here. A $1,250 depreciation deduction the first year. Now it'll be bigger the next year at a 32% rate. We can just copy and paste this formula all the way through here, and you can see here's what we're going to be able to subtract out for depreciation. When we add these three numbers, we get our EBIT. So let's go ahead and do that. 1,250. I'll copy and paste that in place here. And so now I've got a series of EBITs. Now, the net operating profit after tax, again, it says, let's say, suppose we had paid taxes right out of EBIT. So in other words, what we want to do here is to take 1 minus the tax rate of 40%. We're going to apply the same tax rate for each one of these, so again, a dollar sign in front of the I. And we'll multiply that tax by the amount that we have right here. So after you've taken that tax out, we only get 60% of what was left over here, or 750. So we'll go ahead and copy that and paste that in place all the way through here. Okay, and that will give us the information that we're going to need from an operational standpoint. So let me just kind of highlight these, as here's our operational cash flow information. And I can get rid of those blank lines. The final thing that happens here is what happens when we shut down. And what we're concerned with here is not just what the salvage value would be, but what is the change in the salvage value? Because we were going to experience some salvage value there previously. So we want to find out how much has that adjusted in our thinking, because we're making our decision at the margin. So the change in the salvage value is going to be equal to the following here. It will be the salvage value at times 6 of the new equipment, which was, did we mark that down? Let's see, it would have a salvage value here of 800, and that's something that we had not marked down for the new equipment, so let's go ahead and put that in place here. So I'm going to just move that tax rate, and I'm going to simply copy and paste this in here. So there's the old equipment was 500, the new equipment was 800. And the change in the salvage value then is simply the difference between the two. So we're going to have a net gain of 300 beyond what we normally would have had if we don't replace the equipment. In terms of any return in net working capital, then what we're going to get is the opposite of what happened here. When we put 1,500 aside at time 0, we're now going to release it. Finally, do we have any capital gain that change that we need to be concerned with? Well, this is fairly simple because both of these were down to a book value of 0. So whatever the change was right here, we're going to have to pay taxes on that additional amount. So it's a negative of the tax rate of 40% times this $300 gain in salvage value. So we have a $120 tax bill that we did not have previously. And this would represent what our terminal conditions are. So when you put these things together and we want to take a look at what's gone on here, our cash flow is going to be equal to the $750 net operating profit after tax plus our depreciation. So the depreciation, the negative $1,250 that we took out here, we can add back in, giving us actual cash of $2,000. Now we can copy that through to each of these, and these would be the operational figures. But in the last period, we also have, in addition to that, we have the $300 salvage value, we have the $1,500 return of net working capital, and we have the tax bill on the additional gain of $3,232 is the total. And then when we want to evaluate this is to find the NPV. Here what we're looking at is we've got a weighted average cost of capital of 15%. And we're asking the question here is, do we have a positive net present value? In other words, is the time zero cash flow outlay of $7,160 worth? And so we'll go up here to the function wizard under financial, and we'll choose the NPV function. The NPV function says, well, let's evaluate that at rate, that our weighted average cost of capital right here. And for the values or the cash flows from time 1 all the way through time 6. And so we're asking, is it worth paying $7,160 to get a value of over $8,000? And indeed it is. So we will replace the equipment because we've got a net present value that is indeed positive. And that's how you would do a replacement problem.